And thanks everyone for joining us. Really appreciate it. I'd like to first just kind of set the stage. The advice market is changing in lots of ways, demographically, structurally, and a slew of sort of new products and vehicles coming to market, including active ETFs, direct indexing, semi-liquid alts, and others. Adding to the list of things advisors are looking for is balancing client concerns around things like inflation, taxes, volatility, retirement income, et cetera. So here to discuss all those things with us, I'd like to welcome my panel. So first we have Ben Doob, who's head of business at ISS Market Intelligence, Onar Erzan, who's head of the client group and head of Bernstein Private Wealth Management at AllianceBernstein, Jonathan Kingery, who's senior VP and head of U.S. Wealth Management Sales at Franklin Templeton, and Michael Schweitzer, head of North America Client Group at Janus Henderson. So welcome to the panel. Thank you all.
Thank you.
Great.
Thank you.
So let's start off. Onar, do you mind? There's a survey that ISS conducted that included 800 advisors across all channels last fall, and they asked advisors to identify their top concerns. And the responses sort of in order were managing client expectations with about 50% overall choosing that as a concern of theirs and 21 putting it as their top priority. Managing market volatility with 42% of advisors choosing that option and 12% making it their top priority. And finding time to evaluate managers with 38% of advisors overall considering that a top priority and 24 saying it was their number one. You wear two hats at AllianceBernstein. So from your perspective as the head of the private wealth unit, how do those findings resonate with what you see or hear from your advisors?
No, it's very consistent with what I experience day in, day out. The way I think about this is client experience at the end is the thing that matters, and advisors are responsible for owning that client experience, good and bad, and hence, seeing that client expectation point at the top is definitely not surprising. But I think the important, maybe the not surprising observation I had is, product is part of that experience, but it's very broad, right? It involves the technology experience that the advisor and the client has. It's the onboarding experience on the more operational side of things, the capital call experience when it comes to alternatives and things like that. So it's pretty holistic on that. And then when it comes to market volatility and other aspects of the survey responses, absolutely. Ultimately, advisors not only want to know about a specific product and a solution, they want to understand the broader capital markets perspective. They want to understand the implementation of a strategy because that matters from a tax perspective. You touched on taxes. That matters from a time to deployment perspective in alternatives. So that definitely is consistent. And then the whole finding the time to do research on the managers, that comes to the importance of communication. Ultimately, you need to be able to articulate how the solution fits into a broader portfolio. And then if you clear that hurdle, then you need to be able to explain why that solution is differentiated vis-a-vis, in many cases, tens, if not hundreds of competitive products out there.
Great. And then from your perspective overseeing product at AB, when you think about approaching advisors, what are the things that you think, asset managers need to think about when walking into an FA's office?
Our focus is very much leading with content practice management and focusing on typically high net worth and ultra high net worth audience. So within that, we definitely want to have a consistent capital markets perspective and would like to have that broader understanding. Then we would like to really be able to bring it to ideas that can be articulated and implemented consistently. And that gets to, again, tax efficiency of the vehicle, the customization when it's applicable, and the whole, again, implementation aspects of alternatives. So we try to deliver a holistic solution and then add the practice management, which I know we'll come back to in the conversation, right? So it's basically the capital markets, product efficiency and effectiveness, and then helping the advisor with the practice.
And then, if we move to you for a second, sort of what does it resonate with you see in the market? You work with lots of managers, lots of distributors. When you think about your survey data, what do you think it says about what advisors have to face down in 2025?
Yeah, so I think, and I want to touch on a number of things, right? But I think that number one, and we conduct a lot of interviews throughout the year, right? So this data came from one of those snapshots. But we try and keep kind of a pulse on the ebb and flow. And I think overall, right? I mean, I don't think these things are shocking, but I think at the end of the day, you have an advisor who ultimately is being presented with a lot of change in the market. So there's a rapidly expanding product menu. There's a lot of other types of ways to get to outcomes today than maybe there were before, whether that's model portfolios or use of more fintech solutions. Obviously, there's new products coming out. But I think for a lot of what we look at, right, in the survey data coming back is like, what is the advisor or the advisor team or practice trying to achieve, right? And I think it still comes back today with this sort of umbrella of they want to grow their practice, right? They want to be able to grow and scale their practice, right? And so in the context of that, what do you need? What's required, right? And I think that there's, and the team here that we have on the call today will touch on a lot of ways that they're really delivering in this regard. But when we get the feedback, there are specific things about evaluating managers or managing client expectations. But in a world where they're trying to scale their practice, they have to evolve their value proposition, right? The bigger the practice gets, the more types of clients they have, the more types of portfolios they may have, the more outcomes they need to manage to. And if they start to outsource any of the manager selection or use models or other types of vehicles, it may change the value prop for them. So defining that value proposition in the context of scaling their practice, I think is really important. And then that opens the door, I think, for the other needs, right? Which is operational efficiency and the ability to be as informed and effective as possible at their own interactions with their clients. And so I think on those, if you think about scaling in the context of a lot of evolution of the market, and then doing that in a way that's both efficient for them and enables them to be just as effective and just as informed and appear just as smart in front of their clients, that's where the partnerships really come into play. And we test a lot of that in the survey work. And I think that, Michael will talk a lot about what they're doing in terms of trying to leverage data, to be more prepared and more dialed into each advisor's individual definition of what success and growth looks like for them and how they deploy products. And I know Jonathan will talk a lot about how evolving the product set and bringing the different types of products and different types of solutions to these clients can help them achieve their goals. So from a survey perspective, I think we look at it through that kind of context, which is what is the advisor ultimately trying to achieve? But then within that, what are the implications of growth, of efficiency, of trying to keep pace with some of the evolution, and ultimately using the best things out there to deliver the best outcomes for their clients, keeping in mind that the client base is going to be larger than ever for them with a diversified set of outcomes. And so it creates a lot of complexity. And I think that creates opportunity, for asset managers and partners to engage with them in an effective manner.
Thank you. And if we could pull up slide 3, I mean, just to your point about articulating a value proposition, it's a lot of competition out there, right? Your survey data showed that 37% of advisors worked with only 4 to 6 asset managers. About 28% work with between 7 and 10, and only about a fifth of them will work more than 10 anyhow. So maybe Jonathan, if we move to you, Franklin's obviously got a very broad array of specialist units, vehicle types, and thought leadership to offer. But it's a lot for advisors to sort through. And again, as 24% of the respondents in this survey, for example, said that assessing products and the manager is the number one task they need help with. So can you talk a little bit about how you address that?
Sure. And good morning, Hannah, and thank you for allowing me and Franklin Templeton to be a part of this discussion. It's a good segue because you just mentioned a statistic that 37% of respondents only work with 4 to 6 asset managers. And that's a trend we've been seeing over the last several years, that advisory firms and advisory teams are looking to go deeper with your products. I think part of that is probably a byproduct, as what's been mentioned, a very rapidly changing product set. So if an advisor has the ability to meet, and I know it's a cliche, but if our team is coming in with a very consultative approach to understand both the advisor and the end client's goals and pain points, and then we can help direct them whether they want to look at alternatives, they want to look at private funds, they want to look at ETFs, SMAs, CITs, mutual funds, with this evolving product set and where the market industry is going, we're able to help usher them along the way and be that resource for them in a very crowded place, as opposed to hearing different things from different firms all around. So I think that's has been an advantage for us to be able to meet the client where the client wants to be met. And it's just really understanding what their pain points are. I also just want to mention earlier, I had breakfast with an advisor this past week. It's the first time I met this advisor, and I had posed this question to him. I thought it was interesting to the earlier parts about managing client expectations and market volatility being at the top, because the number one thing he said to me was around behavioral finance and their job to make sure that they're keeping clients invested and staying the course. The clients want to feel comfortable and secure, and anything that we can do to help educate them, to educate their clients as well. So I think that these surveys are in line very much with what we're seeing day to day.
Great, thank you. And I just want to remind the audience also to feel free to write in questions as we go along if you have any. But sticking with kind of the idea of building models and helping advisors kind of sort through how to put things together for their clients and keep them invested and communicate that. Again, the ISS survey showed that about 54% of the 800 advisors surveyed build and manage their own models, and about 27% use sort of pre-made models. And then there's a group that customizes on top of that. So how does your approach with working with each type of advisor vary?
Sure. Yeah, and there is a wide range of ways advisors can work successfully. And as I mentioned, it's our job to meet them where they want to be met. So you have some advisors that are really looking to scale their business, be as efficient as possible, and they want to utilize third-party prepackaged models. And we have that through our Franklin Templeton Investment Solutions to provide for them. You take it to the next step where an advisory firm or team may want to outsource their models, but they want some custom work around it. So that same team will work with firms and advisory teams to create white labeled models for that team around what their asset allocation views are. And I think as you go out further of the spectrum, advisors that simply want to build their own models, but they want a third set of eyes, we have a portfolio construction team that's chock full of CFAs that just give another set of eyes to be able to compare and give some data inputs to what they're doing with their portfolio construction.
Great. Are there any certain types of advisors that fit those groups? Like in terms of channels, I guess I'm asking, or is it across, do you see the same kind of types of advisors across the entire spectrum?
There are some nuances. We tend to get a little bit more into the custom models when you get into the independent space, more so on the third-party models in the portfolio construction when you get into the broker-dealer world.
Got it. Thank you.
Yeah, Hannah, if I could jump in for a second, I just wanted to build on Jonathan's point very quickly on this, which is two things, right? On the first chart we shared, while it's not often cited as number one, the personalization aspect is pretty high, right? It's on people's list. And so obviously portfolio construction goes beyond just picking the right product or the right performance, but creating the right outcome. And so we see a lot of opportunity, right, for firms like Jonathan's and others who are engaging in ways that helps people get to a more personalized outcome they feel like they need to deliver, right, through the product selection or the portfolio construction. And for some people, that will be different elements of that portfolio construction dynamic we talk about, customizing, taking something off the shelf. It depends on who the client is for them. And the more that the partner can learn about how they're running their business, the more they can help them achieve that personalization goal, which I think is just increasingly kind of top of mind that's coming through. And I think the only other piece I'd mention on the channel side is just to be cognizant of the resources that we'll call the platform home office level, right? Clearly in a wealth management or wirehouse channel, you're going to have a lot different dynamic than someone out in an independent scenario or an RI scenario with an investment counsel. So you're just going to have some different dynamics you want to play with, and you want to be able to plug into that as effectively as possible.
Another top concern that we talked about was advisors needing to manage their client expectations and ultimately grow their businesses. So how do you ensure that when one of your teammates is walking into an advisor's office, they're kind of ready to help right out of the gate?
Yeah, it's a great question because today people are more stretched for time than they ever have been in the past, right? And many advisors now work in a different jurisdiction than maybe their team is. So they're out on the road quite a bit. That's just a byproduct of the COVID pandemic. So we really, advisors tell us really three things, and we try to align around that. One, they tell us, look, come prepared. Don't waste my time, right? And these are table stakes, but it's amazing how often, they kind of get forgotten. So, the basic things like table stakes are understand my team structure, the roles and responsibilities on my team, our business focus, understand the approach, our approach to investing, both investment philosophy and disciplines. Those are kind of table stakes. You can get that stuff easily off a website. So to go into a meeting and ask about that will just frustrate your advisor because they point their clients to that website, has all that information. So that's the easy stuff. Have an agenda, stick to it unless guided otherwise. Set that expectation up front. I built a couple of private wealth businesses in my prior life on the other side. And one of the things that we always did with advisors is we kept them to 15 minutes as part of that process. And it is absolutely amazing how much information you can share in a 15-minute meeting if you're well prepared. If you're not well prepared, it's very difficult to get past the niceties. But if you're well prepared, you can have a very robust conversation. And you can always ask more time from the advisor if, in fact, you're engaging. But it shows respect along the process. 2 is bring insights. I know it was mentioned a little bit earlier. Bring insights and value that help me deliver a better experience or outcome for my clients, right? So they really, advisors think about 3 things: investment management, wealth management, and business management. So where can you add value along one of those spectrums and really focus on helping them change the outcome? And the third, we say be consistent. Say what you do what you say. Again, I'm always surprised at kind of the inconsistency of follow-up. We come in strong with the idea, we don't get the bite, we move on, we go somewhere else. But showing up, following up, delighting me and my team by anticipating our needs is one of the critical factors in really building strong connectivity with advisors. Example of that is, if I have to come to you to get information about an investment that might be challenged, that's probably not a great outcome for me as an advisor. Because if my client's calling me and I don't have the information, I'm not looking great in front of them. So oftentimes the phone gets heavy when things get tough, and you gotta guard against that. So those are the 3 things we really touch on with our teams all the time. Come prepared, bring insights, be consistent, do what you say what you do.
One of the things that I know you all have announced a partnership with AMP Tiffin. And I mean, how do you use kind of, AI, big data, whatever it might be, to help kind of, arm the salespeople as they walk into offices and have these conversations?
Yeah, we're really excited about this because what we've done is we've taken all the various data sources that all of my colleagues on this call also, participate in, and we've mashed them into one data cube, cleaned up all of the redundancies, and now we're massaging that data with machine learning and AI overlays to extract insights, right? The more time zones we have, meaning, some data comes weekly, some data comes monthly, some comes quarterly, all of that, as we mash that together and then look at it kind of on a longitudinal basis, we're grabbing insights around potential asset flows and gaps and things like that heretofore was done very manually by our folks, right? They would go in, they would kind of look at it, try to figure out what the opportunity was. We're going to be able to tease all of that up and marry it with our content and deliver custom communications directly to the advisor, and then put it into workflow to make sure that we have that follow-up. So it's really exciting from that standpoint, and it's helping us understand next best products. It's helping us understand where gaps may exist in the portfolio, but doing it at scale, number 1, and then number 2, doing it on a very personalized or individualized basis. And I think that's the next iteration here. The days of sending out 25 emails and then sending out another 25 emails, another 25 emails, and they all look the same, I think is a thing of the past. You want to extract from your CRM, your most recent conversations, insights, maybe observations you had or learned in that meeting around a child graduating from school or something going on in the family. All of those things show that you're listening, and it sets you on a different plane than your competitors. So it's doing those simple things, but doing them very, very consistently, leveraging machine learning and AI that allows you to do it at scale. In an efficient manner too, I should say, very efficient.
Yeah, and one quick comment on that. We have an attribute we measure with advisors twice a year on their perception of how well the firm they work with understands their business, right? Business understanding. I'll just note there's the difference just in the top kind of 20 firms that get rated in the market. There's a 3x difference between the bottom of the chart and the top of the chart of perception of business understanding, right? So there's a wide variety here of impact in the market. And so I can't underscore enough how much of an opportunity that is to what Michael was talking about, Jonathan was talking about, and I was talking about. I mean, again, you walk in prepared, right? The ROI and the lift on that visit is substantially higher. We have firms in the data set that get more satisfaction lift out of 1 visit than other firms get out of 6. Okay?
Yep.
And so that's just back to the preparedness and sort of walking the walk. So couldn't underscore Michael's comments enough. Exciting to see what you'll be able to do with that for sure.
Great comments.
Just to go back just quickly, like how does that data that you're using inform who walks into the meeting? I mean, whether, you talked about efficiency before. So does a wholesaler bring a product specialist or how you approach a meeting in the first place?
Sure. I mean, all of our firms I know have specialist groups. We've created the specialist consulting group, which is about 25 specialists across a variety of disciplines. We purposely put them into one team because we want them to operate like an advisor team, right? Fully integrated, sharing information, being seamless, so that we can bring insights to the team that the team would not expect. That's one of the ways you can delight the client. But as we extract that data, whether it's a portfolio manager or a client portfolio manager or a specialist or someone else, that's one of the real values you get out of this data is you can directly figure out who best to bring to that meeting. Oftentimes, if you identify a gap in an allocation, that's going to bring your portfolio construction specialist into that meeting to talk about why there might be an opportunity to take on exposure or to rethink the risk and the underlying risk of the portfolio. So starting those conversations, I would tell you that probably a third of our meetings today involve a specialist, whether it's virtual or in person. In fact, that's one of the benefits of all the mobile devices these days. We can pipe in our specialists virtually, and it gives us a lot more capacity in terms of meeting counts for those specialists. So we're using a combination of in-person and virtual to do that. And that seems to be really well accepted by advisors today. And it's economically very powerful for the firm as well.
Thank you.
Hannah, something I may just add in. From our perspective, I don't know that we would use data so much to decide who we would bring in, but you use that data to be informed when you meet with the advisor. There is a question in the chat, and I'll just stress, what questions do you find most effective to get advisors to open up about their business? Advisors sometimes don't want to consult if they want to hear about your strategy. So the data, whether we're looking at ADVs, if we're looking at the advisor's website, if we're looking at data packages from the firms, if we're looking at our CRM, we should have that information to come in informed when we meet with the advisor, to have a really good sense. We've done due diligence on their business, their practice, and asked them to fill gaps. Once we can fill those gaps, then we tend to know which specialists need to come in. I don't want us coming in charging ahead with one thing in mind, and then the advisor really wants to go a different area. But it allows us to be informed when we first meet. And to the question, what are some things you can ask, get them open up about their business? I think if you can get an advisor talking to you about their 2 to 3 largest clients, who are their 2 to 3 largest clients, tell me about what's happening with them, what are they dealing with, you're going to understand their business. So I just wanted to add that.
Owner, I know you if you could talk a little bit about the Advisor Institute. I know that's also very focused on behavioral finance, and if you could kind of talk about some of the examples of the way that that works and how that helps.
Yeah, Michael and Jonathan touched on these as well. I mean, in our organization, we created the Advisor Institute many years ago. It basically focuses on several things. One, help advisors grow and manage their business. Number 2, help with clients and prospects, how to be more effective with them. And then last, basically help them lead their teams more effectively, right? At the end of the day, in most of the cases, either they own small businesses like RIAs, or they manage large teams inside large organizations. But ultimately, it comes down to those 3 main headlines. And this goes back to, again, our focus on typically helping advisors with high net worth and ultra high net worth, right? You could be focused more on the affluent clients historically, and you might be seeing the opportunity in the high net worth. How do you take your practice that direction, right? So how do you introduce more high net worth and ultra high net worth clients? How are you approaching prospecting, right? Or it could be more in terms of if you are approaching those kind of more sophisticated clients, how do you bring more sophisticated subjects to the conversation? How do you introduce alternatives? How do you introduce different concepts around tax management? And in terms of team management, I mean, for most of the advisors, obviously growing their team, being efficient with their time, but also thinking about succession is critical. So we basically bring our expertise in both wealth and asset management to really help the advisors with that whole succession planning as well. And a number of these things are very emotional and deep in terms of engagement. I mean, ultimately, you need to be relevant, you need to be trusted to earn that right to have those conversations. But when we earn that right, which we do hopefully consistently, then we get into these kind of areas. And then scalability matters. I mean, Jonathan and Michael and Ben touched on it from a data perspective. I'm not going to go deep into that, given that was covered, but we also approach practice management in terms of how we deliver the best-in-class insights on a scalable basis. And we created a digital tool, which we call the digital coach, so we can bring these modules to advisors and we can customize it based on the advisor's priority topics and areas. So they can engage with a simple questionnaire along the topics that I laid out, and then pick the areas that they want to get deeper in terms of helping manage their business and team and clients better.
Okay, thank you. Jonathan, do you want to touch on behavioral finance? I mean, some of the elements that you see in the field or you're helping advisors with in terms of their clients?
Yeah, it's certainly it's helping keep, as the advisor said, keeping clients feeling comfortable and secure, which is ultimately what we lend to, at least financial security. We have things such as in our Franklin Templeton Academy, 6 barriers to investment success that talk about unconscious biases. It could be home country bias, it could be investment herding, but these are ways we aim to educate, help arm the financial advisors, so then when they're at the table with their end clients, that they're able to keep them steady.
Okay.
And I think owner mentioned at the beginning as well, right? The setting expectations, right? And demonstrating value, making sure the expectations they set and the value they're trying to demonstrate aren't necessarily just tied to, pure performance reporting, which can lead to some, more overcorrection sort of actions, right, in different periods of volatility. And so to Jonathan's point, owner's point, right, like how do you help the advisor define the value, the outcome, and the expectation properly so that they can stay the course, right, and avoid some of those pitfalls.
Thank you. So I'd like to also move to sort of the types of products and strategies that you guys are seeing, advisors are in demand with advisors this year. Ben, you asked advisors about the types of vehicles that they intend to use going forward, and what they may kind of increase and what they may pair off of their portfolios. So the 3 that seem to be poised to gain the most this year, at least, or in the coming 12 months, are active ETFs with a 53% of the respondents saying they would increase usage, direct index products with 38%, and SMA and alt private market offers 37 each. So, I guess I was wondering if you could sort of, it kind of indicates a play at cost, taxes, customization, and concerns around inflation. And I was wondering if you could talk a little bit about how those themes inform managers' approaches.
Yeah, for sure. And again, I think there's a lot of commentary from my peers here on the call as well that would be very helpful here. I mean, I think, look, when we measure this, frequently, right? So this is obviously a snapshot in time, but I think at the end of the day, it's been pretty apparent out there. There's been a rapid ascent, more recently of active ETF flows, certainly taking off considerably now across both, equity and fixed income. Obviously, a lot of attention on alternative investments and bringing those in, maybe into a more, broadly accessible type of environment. But again, I think here it's back to some of the things people have talked about. Every advisor is different, every practice is different, every portfolio is different. And so you have to know that client, you have to know what they're trying to do. But I think ultimately at the end of the day, we do see, a lot of desire to increase the use of certainly an ETF vehicle, whether that's active or passive to an extent. And for clients or for advisors who have sufficiently high net worth enough clients to be able to participate in alternatives or to participate in things that may have capital calls or capital tie-ups, knowing that and being able to explore that, those are certainly in demand. But the thing I would flag here is, a lot of them come into play for a couple different reasons, right? Certainly, there is a desire to get more tax efficiency as well as cost benefits when you think about things like ETFs. But not everyone can just flip the switch, right? Understanding where the client is from an unrealized capital gains perspective, some of the vehicles they've had for a long time, like that's where technology also comes into play, and mapping them from point A to point B and helping them mitigate some of that tax exposure. There was a question in the chat about people retiring, right? And being concerned about how their money is going to last. And again, a lot of them are going to have unrealized capital gains that are inflating the value of that portfolio. And that's going to change if we start changing a different vehicle. So I think the challenge is extreme in terms of combining knowing the client and then knowing what these general vehicle trends are and where people want to move to, but then figuring out how you're going to actually work with that advisor or that practice in a way that fits their business model and helps them figure out where the best opportunities are for those vehicles, because it's not just a one size fits all. And so I think that when you look at what Jonathan was talking about earlier, or Michael was talking about earlier, like for each of these client interactions, right, making sure you're prepared, and you may have a broad menu of things you could talk about, but it's got to be made into put in the context where it can actually, fit into that practice. And so we see a lot of demand for active ETFs. We see a lot of demand, certainly for SMA in certain channels and the ways to get custom and bespoke outcomes. And we see that coming at the expense, of course, of, your traditional open-end mutual fund. And what's also noted is, there's been a lot of cash on the sidelines. So back to the behavioral finance element, how do you get people to keep their money invested? Well, there was a lot of money that got pulled out and put on the sidelines. Where does that money go into? What vehicle does it go into? What sleeve does it go into? How do you deploy that? So we think that the vehicle demand is really strong in terms of some of these new vehicles, but the holistic conversation of how that applies to the advisor practice, and then how you can demonstrate how you can bring the right things from your portfolio into the client's portfolio is kind of where the rubber meets the road, right? And I think the last thing I'd mention is the firms that have done it, the firms that have done this the best have really been able to do it via more cross-sell than cannibalization, right? Finding ways to help their advisor clients with additional product types, additional vehicles, additional ways to help, to Jonathan's point about really going deeper with certain partners than just cannibalizing their own, vehicle with a new vehicle. And I think that's been encouraging to see, because it means the conversations are providing more value.
Yeah, I would just overlay with, if you go back to 2008 and you look at the breakout of passive, against kind of mutual fund flows back then, and then you look at kind of 2024 and active ETFs against that same deal, the charts look almost identical. So, we have the future and we've seen it in the past. And to Ben's point, flexibility, tax management, right? You think about your ability to manage taxes, not as much in the mutual fund, more so in the ETF, absolutely customized in the SMA. And as wealth continues to move up the spectrum, 64% of assets today are in the hands of people that have 2 million or more of investable assets. And it's growing at 2x the rate of the core affluent. So those products, that's why it's becoming more and more prevalent and relevant to advisor practices. And so someone said earlier, you got to meet them where they are. Absolutely. You also have to be thinking about where they're going and bringing those ideas to them, because you're looking at a proliferation of interval funds now, right? So kind of that tweener between the 3C7 fund and a mutual fund. But there's pitfalls with those too. You need to understand, when they work and when they can be challenged. So a lot of that now is falling on the shoulders of our wholesalers, which is just another reason why you need specialist support around that, because the generalist model is really around directing the specialists in to solve the really specific acute issues. And I think that's the operating model that we have going forward. If we're going to keep up with these teams who are getting larger and more multifaceted and hiring more specialists on their own teams, we've got to be in some way, shape, or form the specialist to the specialists.
Michael, maybe let me jump in. I agree with the importance of vehicle. We have seen a huge amount of innovation with the active ETFs, the SMAs, CITs, all of us talked about it. To be honest, I think even the vehicle flexibility is now getting commoditized, right? So particularly for the most sophisticated advisor teams, they already have experienced a bunch of these products. They have already incorporated into their practice. So to me, another dimension right now, and we are definitely investing in this, is to really build the experience around the vehicle, right? So I'll pick a simple example to make the point. Again, let's think about a relatively simpler asset class, right? Tax-exempt fixed income, right? So in that, of course, we have the SMAs. You can make it more custom. You have the active ETF companion for smaller accounts. But what we are seeing from the advisors is not only show me the vehicle and the implementation, but tell me what is the benefits that you are delivering beyond the relative performance. And then we invested quite a bit to talk about the speed alpha, like how fast are we deploying into a relatively illiquid fixed income market, right? How are we measuring the tax benefits so that the advisor, going back to client expectations, they might be talking about tax efficiency, but don't tell me you're funny, make a joke. How do you help the advisor kind of bring that tax benefit or the tax alpha they delivered to the meeting with their clients with a report in their hands? And then also, how do you help advisors win business, which goes back to how do you use technology to do real-time transition analytics and things like that, so that when they talk to their clients, they have a solution where they can talk about all the different complexities of managing a client from another advisor to their practice and how to deal with the implementation issues, taxes being the most obvious one, but how do you deal with stay behind alternatives? How do you deal with all the other aspects of the portfolio? So vehicle is, I agree, 100% important, and we will all continue to invest, adding new vehicles to have that vehicle flexibility. But ultimately, it feels we will need to all continue to invest to build even further experiences around those vehicles as well.
Yeah, owner, just on that point, I think one of the most important attributes we see in terms of driving advisor sentiment and satisfaction tends to be on what we'll call the qualitative screening side, the people, the process, the rationale, the benefit, how you communicate on the product. And we find that sort of vehicle agnostic, right? So to your point, SMA, ETF, mutual fund, whatever it may be, if you can't deliver that story in a clear way that demonstrates value, calculates that value, and follows through on that communication over and over again so they can really understand the choice they're making, the vehicle won't carry the day, right? It can carry the day so far, but you have to have that qualitative, the people, the process, the rationale, and the benefit really dialed in. And so I would fully agree with what you said there. And we just see that being a much bigger differentiator than, it takes you from like, do I check the box of having the vehicle to, is this actually a choice an advisor is going to make?
I think process, you make a great point, Ben. I mean, process is at the core. If you want to be a generational partner to teams, they have to understand the process, and that the process is what drives outcomes over time. And that allows you the variability or challenges of stressed markets, which we all know are the best times to invest often, but always the difficult or the most difficult time to do it. But if they understand process and that you're sticking to that discipline and you can prove it out, that improves your odds of staying in, as a partner.
Absolutely.
In one of those seven partners. And that's really what we want to do. We don't want to be traded out, on the market cycle. We want to be there, to grow wealth over time.
Yeah, absolutely. And I think, and to your guys' firms that have a wide variety of products, and Jonathan, I point you to, like, you start to expand all these product types. How do you make sure you connect the dots so that process looks like you can see the fact that DNA is threaded through all the different things that you're able to deliver, so that they don't have to relearn it each time, right? That's back to that kind of, how do I anchor on a partner who's got that DNA through, regardless of what vehicle we're talking about, but I understand the people and the process that are making that thing go.
That's where, if you can give optionality to the advisor, saying we have this team, say we're talking about municipals, you can access this team, whether it's in an SMA, it's in an ETF, it's in a mutual fund, but the team, the people, the process remains the same.
The only other thing I mentioned here is just the common thread I'd point out, hearing, Jonathan and Michael, owner, talking, like, I mean, we see this in the data, right? Is that, performance will come and go in any given time period. You can control as much as you can control, but the way you engage, the story, the consistency through which you engage and communicate your process and your people, in our data, that's what we see differentiates people that stay basically toward the top and people that are moving up and down, whether that's within one advisor book or just overall league tables or whatever it may be. But the question of, how well can you tell your story? How well can you engage, and how well can you communicate your process over and over and over again, regardless of what the current situation is, tends to be the bigger differentiator. Because performance will come and go and fee levels will come and go, but it's ultimately how well you can do that on a consistent and scalable basis that matters. And we just see that time and time again in the data, and much credit to the firms that are on this call today for being able to do that consistently over time as well.
Yeah, and I think the risk management matters as well. I think we touched on it too, going back to doing what you say, what you're going to do. And obviously, I think our collective challenge, both on the asset management side as well as advisors, is, staying up to date with all the new innovation in capital markets and different solutions and all that, and making sure the way we talk about the solutions is appropriate, right? So like in the past, maybe alternatives were always sold as, with a high return solutions. Then there was a period where hedge funds became much more, absolute return, less correlated kind of pitch. But if you think about it today, like for instance, in private credit, in most of the cases, you might be talking about more a consistent income story, and you need to make sure you are able to think about the investment outcome in the appropriate way so that you're not creating false expectations, because some of these things are not going to be double digits. They're meant to be consistent single digits, but you need to be upfront about it, and you need to talk about how they enhance the overall outcomes for that client in line with the client's needs. I know it's, again, cliche to say that, but we know in many cases that whole process is not always consistent. I think Michael was talking about the consistency of the process.
I just want to jump in. I mean, just to stick with the idea of alternatives for a second, I'm looking at the questions that have come in. I mean, Onur, I think you just touched on this, but I'd like to hear from Jonathan and Michael a little bit about this idea that, you do have a lot of traditional managers coming into the advisor space.
So, look, first of all, sometimes products change because the markets change. And if you look at why alternatives are getting such traction, we have half the number of publicly traded companies today than we did 20 years ago, right? So if we look at things such as, the number of companies in this country that have over 100 million in revenue, 87% of them are now private. So there's such a large amount of the market overall that investors should be accessing or want to get access to. I'll give you one more stat here. In 1999, the average tech company stayed private for 4.5 years. Now that's almost double, 7.5 years. So companies are staying private longer. There's more private companies, and that naturally is driving more demand to get into the space that has traditionally been more institutional. So you take a firm such as Franklin Templeton, Janus, or AllianceBernstein that has a long heritage and pedigree of understanding the wealth management space. We understand the advisors. We understand what they're ultimately trying to achieve. We're as good as anyone out there to help educate them. Franklin Templeton has quietly become the 6th largest alternative manager in the industry, with Lexington Partners and Clarion and Benefit Street Partners. So we feel we have every ability to compete head-to-head with the KKRs and the Blackstones, because we know the client, we know what they're trying to achieve, we have the relationships there. Now it's a matter of, can we help educate them? And a lot of the education is about, number one, how does it fit into the portfolio? If I'm going to use private credit, where am I pulling from in the public markets to fund private credit? It's, how am I going to access this? What are the operational issues in dealing with these type of vehicles that are not as liquid, which goes in the last part, is the liquidity around it. So just going through some trends on why alternatives we believe are a secular trend because of the private markets and where it's going, and why firms such as ours have traditionally been on the public side can really help educate the wealth market.
Yeah, just to add on the back of Jonathan's comments, because I think that.
Yeah, great.
Oh, sorry. I was just going to say, for the longest time, alternatives were a transaction, right? There was your alternatives portfolio, and there was your other portfolio, right? And there shall the two meet, right? We didn't think about it in the context of what are the capital call downs, what are the unintended consequences. As private credit has proliferated, people have exposure to multi-sector, core plus, different things like that. What is it doing to the portfolio as you start to make commitments to that? So we're spending a lot more time, and we've integrated our portfolio construction tool now to look across the public and private sector, integrating it to help advisors understand, all right, what do I have out in front of me in terms of capital calls? When can I expect those to come down? Where am I going to fund it from? What is it doing to my overall allocation? Given the J curve and all of that, you really got to manage it now much more actively in the past. It's not just saying, hey, I'm going to commit X amount of dollars to whatever fund, and I'll just let it call down. How does it fit within the portfolio context? So you're starting to see a lot more of an endowment-based approach by advisors who have clients who can start to allocate and build diversified portfolios. And that's why you're seeing a lot more interval funds as well. Number one, to push it down to a broader set of investors, but two, to really fine tune allocations within portfolios at a price point or at a dollar amount that's less than what the traditional kind of point would be if you think about allocating and diversifying across the various disciplines, manager, vintage, manager within different strategies. You start to put that together, you need quite a big allocation to alts to actually do it properly. But as technology and all of that has come, we're lowering those price points. We're also creating more risk if we're not careful for those clients who don't really understand in depth the illiquidity element of these portfolios and the fact that a fund may say it's an 8 to 12 year life cycle, and it ends up being 17 because of the drawdown nature and then distributions.
Yeah, and I'll approach it from a slightly different angle. I mean, in many instances, there are always exceptions, but what we see is our clients want to do more with less managers, right? And you see this consistently in the retail business, high net worth business, institutional business. Again, there are exceptions, but if I were to do the 80-20, that's kind of what we see. So in that world, I think the distinction between a traditionally long only or traditional alternatives firm, that distinction becomes less and less relevant. Ultimately, it comes down to, as an organization, are you able to attract the right investment talent? Are you able to incorporate them into your organization, keep them in your organization, and provide them with capital for them to grow with you, right? So ultimately, it comes down to whether you're able to accomplish those things, and whether you are type A or type B actually is much less relevant. So that to me is the way to think about the future. I think the alt and traditional manager split is more a construct of the past, as Michael mentioned, when the portfolios were very different. Alt was very niche, and the world wanted to simplify and talk about two types of managers. But ultimately, and we have seen that kind of convergence between active and passive as well. It's not active or passive. Typically, it's both active and passive in the portfolios. And similarly, I think there's going to be a handful of managers that are able to win in alternatives alone, traditional alone, but I think increasingly a few will win in both.
Yeah, and I would just quickly add, it goes back, we showed the slide earlier, exactly to owners and Michael's point, right? There are advisors who are going to use very few fund families. There are advisors going to use a bunch, right? And do a bunch of different sleeves, right? Knowing that difference. And, last month we interviewed hundreds of advisors specifically on alternatives. And certainly Blackstone and others were cited as some of the best, but there are a lot of traditional managers, more quote unquote traditional managers, that were cited right in the mix with that. And that wouldn't maybe have happened, a little while ago. So I think the trend is going in that direction. But again, knowing how tactical and allocated they are, how many sleeves they're going to have, how they're going to think about it, that's important. But there's a lot of opportunity, and we're seeing more quote unquote historically traditional managers gain a lot of ground in the hearts and minds of advisors when it comes to delivering the right types of products in that space.
Great. Well, I want to thank you all. Unfortunately, we're just about at time. I know there are a lot of other great questions about retirement income and different ETF chassis. Hopefully, we can get to in coverage and going forward, and come back to you all with those questions. But just in order to close out, I just wondering if you could each kind of go through 3 messages you think that you'll be hearing more of and going forward with clients in 2025. Maybe Owner, we can start with you.
Sure. Basically, I think agility and flexibility. I think there's going to be a lot of uncertainty and volatility in the markets, as we have even experienced on Monday. So that will be key. Second, I think the whole using technology to make your practice scalable, because more things will come at you. How do you make sure you are having the right support and technology to be successful, I think is important. And then finally, again, capital markets perspective matters, because you should be able to think about how different things fit into your portfolio. Again, alts can be great, but you need to make sure what you are using it for. And you need to understand the liquidity and other risks, as Michael and others have mentioned. So those are the 3 for me.
Thank you. Michael, do you want to take a shot?
Look, I think, at the end of the day, if you pull it all together, we've talked across a broad landscape of ideas here. And I think, my esteemed colleagues have done a great job in kind of articulating that. I think pulling it together, at the core is discipline, right? Process and discipline, whether it's an investment strategy or whether it's how you engage advisors, is the key. If you don't have a process, you don't have a discipline, you're really not going to have great follow-up. If you don't have those 3 things, you're not going to have success. There are just too many great people in this industry that are competing for share of mind, share of wallet. You've got to be at the top of your game. And so, that's why we're investing so heavily in technology to create outcomes that allow our people to work smarter, not harder. we've all done the harder bit. We've all been on Wall Street for a long time, and we've outworked our peers or whatever over the years to get where we're at. But at the end of the day, in today's world, it's about working smarter. We always talk about in our shop, how do I create 12 hours of outcome in 8 hours of work? And if I can do that, I've got a business that's going to be wildly successful.
Thank you. Jonathan.
Yeah, I'm going to answer this maybe in two ways. One, and I was fortunate to get to carry the bag for a long time. And what advisors wanted in 2005 and 2015 and 2025, I think is very similar. And that is, how can you help me grow the business? How can you help me run the business efficiently? How can you help me look smart in front of my clients? And that latter was a lot about, being able to articulate succinctly and cleanly the process, because that's what they're going to articulate back to their clients. So those are always going to be themes that we're going to be discussing with our partners out there. But for 2025, to a more granular level, it's what high net worth and ultra high net worth clients are looking for today. And that's customization, it's minimizing tax burdens, and it's accessing the private markets. And those are the three areas that we're going to be probably most laser focused this year.
Great. And Ben, I'll leave you with the final word.
I get the last one, so I got to try not repeat what everyone says. Those are all great answers, right? So I'm going to just offer a couple things from both I think our perspective on advisors and our perspective on the manager partners, right? I think number one is personalization at scale, right? That's a tricky beast, right? You can be super personalized to a small group of people, but it's hard to do it effectively at scale. But that's equally important for advisors as they grow their book. They have to be personalized enough across their book. It can't always be a one size fits all. So finding the ways to do that and finding the partners that can enable you to do that, whether that's tech partners for an asset manager or asset managers for an advisor, you have to find the right fit. And I think 25 more so than anything else, we're going to see increasing differentiation of the people that are able to do that and the people aren't, and they're going to see value out of that. I think the second piece is just recognizing the value prop evolution. So Jonathan just mentioned, wholesaler 2005, 2015, 2025, it goes both sides. An advisor's value proposition, I think, is getting refined and evolving as the market changes. I think distribution and asset managers' value props are changing a bit as they add alternatives, add ETFs, change their vehicle structure, change their sales coverage. The wholesaler has now 4 different specialists that might show up. How do you make sure that works? How do you make sure it's clear? How do you make sure that's a value prop that everyone can understand, that you can grow? So I think those two things, right? Scalable personalization and the refined value prop are going to be 2 big themes. On a more tactical level in 2025, I would certainly echo what Jonathan just said, right? So taxes, tax mitigation, a lot of unrecognized capital gains. How do you help people through that? How do you deal with that, particularly staring down the barrel of a lot of income needs for retirement, and finding the right balance with alternatives? It's not for everyone. It could be, in certain cases, great. It could not be. You got to figure out how to thread that needle and how you can play in that access to the private markets that Jonathan mentioned, because it's a big piece of it. So that's what I would say, Hannah.
Great. Well, thank you all for all of those great insights. I heard a lot about, walking in prepared, articulating your value prop for the advisor, and then helping them articulate theirs as well. Anyhow, I really appreciate all the time, and thank you very much. And thank you to all the attendees and for the great questions, which we'll try to address going forward. Thank you.
Thanks, everybody, for the time. Thank you.
Thanks, Anna. Bye-bye.